Hello and welcome to the latest show of Damien's Midweek Markets, which is the show where I talk about what's been going on in investment markets in the last week and what to look out for in the week ahead. So if we for 1 second jump back to where we finished last week's show, we were talking about the market was dancing to Draghi's tune. So Mario Draghi is the European Central Bank's governor. So he made a press conference which basically said that he would be prepared, or the European Central Bank would be prepared to almost do whatever it takes to keep the European Union economy going. He slightly front-ran the US Federal Reserve, who were due to talk a day or so after he made his press conference, and they had pretty much said the same thing, very dovish. So equity markets loved it and they rallied strongly. So if we just take a look at some key metrics, like I did last week, I thought that was quite a nice way to basically paint a picture of where we are. If you think about this week, we are now on the S&P 500. We've jumped back towards the all-time highs. We've gone to 2,950. We've pulled back ever so slightly, but we rallied very quickly up towards those all-time highs we had in April. The VIX, the VIX, which is the fear index, is a general gauge of fear in the market. That dropped down below 15, which is a key level. Anything above 15 is generally negative for stocks. Anything below is generally positive. And we also saw the oil price leap. And when I say leap, it went from $52 a barrel to $59. That's a huge swing upwards. And of course, as I've spoken about in this show in the last few weeks and months, the oil price has had an impact on where US stocks have been going. And so that's had an overall impact on equities. Generally speaking, when the oil price has risen, we've seen stock markets tend to pick up. And when it's fallen, it's tend to be a headwind for stock markets globally, particularly in the US. Now, the reason the oil price rallied was partly down to supply and demand dynamics, but also because of Donald Trump almost going to war with Iran, which caused obviously a lot of heightened tensions, particularly around the import and export of oils, which saw the price rally. If we jump to the bond markets for a moment, we've seen the yields in bond markets, particularly on government debt, tumble. So we've seen historic lows on the German Bund, which is obviously the equivalent of the UK gilt, but obviously in Germany. And in the US Treasuries, we fell down with a 10-year US Treasury yield fall below 2% for the first time since November 2016. So there's a real divergence that's going on in markets. We're seeing fear fall away from equity markets. We're seeing things that are being very positive for equity markets. There's a lot of hope around central bank action, and they may start pumping money into the system again in QE and cutting interest rates. So that's been very positive. But on the flip side, we've still seen this divergence with bond markets not quite believing what equity markets are saying, not buying into it. And 80/20 investor members will have had last week's newsletter, which went into a greater detail about the jaws of death. So if you want to know what that was all about and what you should be watching out for and what could be negative for the market going forward, then you can do so by signing up for a free trial of 80/20 Investor. So where we are right now is with equity markets pushing back towards those all-time highs, especially in America. In the UK, and we've had the FTSE 100 largely stagnate. It's around about the 7,400 level. The DAX has been a little bit lackluster too, but the mood has definitely brightened from where we were last week. And again, it's based on hope. But if we look closely on the equity rally we've seen, particularly in the US, there are signs that it looks a little bit tired. It needs a little bit more engagement from other sectors, because we've seen a slight narrowing of the sectors that are actually driving things higher. So defensive stocks have been doing particularly well, which is why my 50k portfolio has benefited from those in May and this month. But we want to see other sectors, the more cyclical stuff, things like bank stocks picking up, retailers picking up, if we're going to try and push on through those all-time highs and actually the equity market to keep pushing to the levels we've not ever seen before, particularly on the S&P 500. But the biggest lesson you're going to have this week is about headlines and algos. So when they say algos, they mean algorithms. There are traders out there that are very automated, so they're computer-generated programs that buy and sell things based on what the trade headlines are. So we've had the Fed talking about maybe cutting interest rates or about the economy looking weak. We've had the ECB saying they will do whatever it takes. Whenever you see these headlines, the markets, or equity markets in particular, tend to jump as they scramble to try and get on the right side of the trade before it really takes off. And we've seen that this week beautifully in an example where CNBC reported that the US Treasury Secretary, Steve Mnuchin, reported that the US and China had agreed 90% of a trade deal ahead of this weekend's G20 summit. Now, that has since been retracted by CNBC, saying that his comments were actually retrospective. He was talking about the past. So they had a 90% completed trade deal previously before it all fell apart. Before that clarification came in, we had the market leap about 0.5%. As soon as we had the clarification that there might not be the 90% trade deal in the offing, then they fell back. And that just shows you how this market is so sensitive to what the headlines are saying, so the hope rather than the fundamentals. And that always leaves it very fragile and susceptible to pullbacks, even if we continue to march higher. Now, I mentioned the G20 summit. That's the big thing in the days ahead. So this weekend, the 20 nations that make up the G20 are meeting, and they account for 90% of economic growth in the world and 80% of the trade globally. Now, they're all meeting this weekend, and they include obviously heads of state, central bankers. And the key thing that everybody's focusing on is Donald Trump is meant to be meeting President Xi of China to hold new trade talks or to try and progress trade talks. And now there's a lot of hope they're going to seal a deal at this event. If they do, then I think you can expect stock markets to pop and shoot higher. If they don't, which some are suggesting is the most likely outcome, then we're going to see the nervousness we've seen in recent weeks, and especially we saw in May, perhaps come back and escalate. So it's all about what happens at the G20. Over the weekend, look out for the headlines about what happens between Donald Trump and President Xi of China, whether they actually come to any form of agreement or whether this is going to just trundle on, and more importantly, whether Donald Trump imposes new tariffs on China. If he does, then that could set up next week to be very, very interesting. So that is it for this week on Midweek Markets. If you want to get in touch, then you can do at Damien@moneytothemasses.com, via Twitter, Money to the Masses with the number 2, and of course we're on Instagram as well under the name Money to the Masses. So until next week.